Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
It is indeed a busy, short trading week ahead, and we are kicking off this deep dive by synthesizing the major financial headlines.
That's right.
We're pulling from key sources, primarily reports by Yahoo Finance and CNBC today, December 22, 2025.
And we have three, I think, really crucial and interconnected storylines that are defining the market mood right now.
They really are.
Okay, let's unpack this. Our mission today is to give you a shortcut to being well-informed on three shifting dynamics.
First up,
First, the maturation and, the selective nature of the whole AI investing frenzy.
okay.
Second, the stark reality of escalating global trade friction. And we're talking everything from dairy tariffs to new strategic pacts in Asia.
A lot to cover there.
And finally, the return of traditional hedges as investors start to eye long-term fiscal stability.
And that initial snapshot this morning gives us a pretty cautious start.
It does.
European markets, the Stoxx 600, opened slightly negative, down about 0.2%.
Even after hitting a record high recently.
Exactly. Meanwhile, U.S. stock futures are ticking up, which, suggests a bit of hope.
But the bond market is really demanding attention.
It is. The 10-year Treasury yield is edging up to 4.1647%.
And that's ahead of a critical auction-heavy week. That specific yield number is so important because it tells you the cost of borrowing, the scrutiny on U.S. debt.
Right. It signals an environment where investors aren't just universally buying dips anymore.
They're being discerning.
Very discerning. And that leads us straight to our first and, I think, still the most dominant topic, artificial intelligence.
The conversation around AI has just fundamentally changed, hasn't it? Even over just the past few weeks. We've moved past simple euphoria.
We have. Reports, especially from Yahoo Finance, are really clear on this. The AI tech trade is far from over, but let's say the easy money has been made.
Right.
Investors are now using what they call a selective scalpel.
A selective scalpel. I really like that phrase. It implies precision. We've shifted from buying anything with AI in the name
To actively sorting.
Yeah.
The sources suggest this refinement is actually necessary to create, and this is a, quote, appropriate winners and losers dispersion.
And that dispersion became crystal clear when the market got a little volatile recently.
It did. We saw some hyper-valid concerns surface, specifically around the sheer capital expenditure required for this race.
So things like the jitters caused by funding worries for companies like Oracle for their new data centers.
Exactly. Or even construction delays affecting key infrastructure providers like CoreWeave. These weren't macro fears.
No.
They were micro concerns about execution.
That brief wobble really showed the market is finally scrutinizing the actual cost and the timeline of building out this entire ecosystem. It's a massive capital drain.
It is. But then all that skepticism hit a massive wall of reality.
It certainly did, and that wall was named Micron technology.
Absolutely. Micron's Q1 revenue and EPS results were a blockbuster, fueled almost entirely by AI demand, especially for memory chips.
They just blew past Wall Street estimates.
Totally. And the market response was immediate and dramatic. Micron, MU, closed up almost 7% on December 19th.
And it pulled the whole sector up with it. NVIDIA, NVDA gained nearly 4%.
The feeling was palpable. So much so that a Nomura analyst, Charlie McElligott, compared this earnings upside shock directly to the catalyst NVIDIA provided way back in May 2023.
That's a huge comparison.
It is. McElligott summed it up perfectly, saying there is still blood left in this AI stone.
So the demand engine is still running hot.
It is. But you have to frame this against the sheer overwhelming scale of the Magnificent Seven companies.
Right, the Mag 7. NVIDIA, Apple, Microsoft, Alphabet, Amazon, Broadcom, and Meta. They're not just participants in the market.
They're the gravity well for the market.
Exactly. They're up an average of 21% year-to-date. That's comfortably outpacing the S&P 500's 16% gain.
And they account for roughly a quarter of the entire index's earnings.
So this bifurcation, this splitting, is happening not just between the Mag 7 and everyone else, but within the group itself.
Exactly. And this is the crucial point for you to track. That selective scalpel is being used on the biggest names.
So while some analysts are questioning companies that are raising eyebrows with a lot of the spending that AI requires,
suggesting their debt load or their slow build-out is a risk, you have others jumping right to their defense.
And that's where the divergence gets really interesting. Like, take Oracle.
Perfect example. While they face that scrutiny, you have Guggenheim strongly defending their strategy.
What's their argument?
They argue Oracle has built a better mousetrap for cloud infrastructure. They're citing better performance at a lower cost, all while maintaining comfortable profitability.
So it's fascinating. We're moving away from asking if AI will pay off to asking how and which capital strategy is the most efficient.
Precisely. But strategically, looking out to 2026, the big picture thesis holds strong. Ulrich Hoffmann-Burchardi of UDS stated very clearly she sees no evidence of an investment bubble.
And she's pointing to what?
Fundamentally robust company metrics in the aggregate.
And that sentiment, you can see it. It directly feeds into the optimistic market forecasts. Goldman Sachs is projecting 12% S&P 500 earnings growth in 2026.
A number driven overwhelmingly by the earnings power of those top 7 names.
And that's not even the most bullish take.
No, that's conservative compared to UBS. They project the S&P 500 could advance all the way to 7,700 by the end of 2026.
That's a 13% upside from here.
It is. The whole AI spending thesis is the fundamental assumption underpinning the entire long-term outlook for U.S. equities.
The selective scalpel is just separating the efficient builders from the less efficient ones.
Exactly.
Okay, so if the internal mechanics of the AI trade are getting selective, the external geopolitical landscape is just getting aggressively fragmented.
That's a good way to put it.
Let's pivot from those internal market dynamics to the walls being built up around global trade, a story CNBC has been monitoring very closely.
We're seeing a major escalation between the EU and China. The big news today is that China is imposing steep anti-subsidy tariffs on European dairy products.
Specifically cheese, milk, and cream.
Right. And they're effective tomorrow, December 23rd.
And these are not small tariffs. They range from 21.9% all the way up to a massive 42.7%.
And China is alleging that the EU subsidies for these dairy products caused substantial damage to its own domestic industry.
It's a very targeted response.
Highly targeted.
Yeah.
And the methodology is revealing. Companies that cooperated with the Chinese investigation, they get the lower rate, 28.6%.
But the ones labeled non-cooperating?
They face that top rate of 42.7%. It's a deliberate tactic to influence corporate behavior, encourage companies to comply down the line.
And you have to see this as direct retaliation in an ongoing sort of tit-for-tat trade confrontation.
Absolutely. This dairy move follows the EU's decision last year to put tariffs on Chinese electric vehicles.
Right. And don't forget, China recently cut duties on EU pork, or the EU challenging China's brandy tariffs at the WTO.
It's an asymmetric trade war. They're using everything from cheese to cars as leverage.
This constant friction forces countries to reconsider their major trading relationships.
Which leads us directly to India's strategic diversification. This actually provides a positive counter-narrative to the EU-China conflict.
Right. India and New Zealand just announced a trade pact that will make the majority of goods trade duty-free.
And this is India's third major trade deal this year. They've already done pacts with the UK and Oman.
It really underscores a strategic pivot towards bilateralism.
And the scope of this new pact is substantial. It eliminates tariffs on 95% of New Zealand's exports.
And 57% of those goods become duty-free in India from day one.
Day one. And India, for its part, gets zero duty market access in New Zealand for key exports like textiles, apparel, and autos.
Plus, New Zealand committed to a significant $20 billion investment in India over the next 15 years.
This is serious economic diplomacy.
But what stands out to you, I think, in this deal is India's own shrewd application of that selective scalpel idea, but in trade negotiation.
Absolutely. They insisted on a massive exception clause. India excluded market access for sensitive New Zealand exports.
Things like dairy, coffee, sugar, spices, and edible oils.
Exactly why. To protect its massive domestic industry and its millions of farmers.
So this is the new rule of global trade. Strategic engagement, but coupled with robust domestic protection.
Open the door for capital and manufacturing, but lock it down for your agricultural core.
And the relevance here for you listening is the driving force behind India's rush for these deals.
They're doing this because they're facing major tariff headaches from large powers, the U.S. in particular.
Heavy tariffs. We're talking 50% on certain Indian goods exports and 25% duties on India's purchases of Russian oil.
So when you face high tariffs from major trading partners, it necessitates this kind of strategic diversification into smaller, more favorable bilateral agreements.
It highlights a key dynamic. When global trading systems fracture, individual nations have to build their own optimized, protected networks.
That's right.
Okay, let's transition now from trade fragmentation to market hedges, because this is where we see the defensive side of investor psychology really taking center stage.
And we have to talk about the Surprising outperformance of the UK market.
It truly is a surprise. I mean, despite the constant drumbeat of political instability and economic uncertainty in the UK, the FTSE 100 benchmark index,
It has outperformed Wall Street's main indexes in 2025.
CNBC reported the FTSE 100 gained 21.1% year to date.
That performance beat the tech-heavy Nasdaq Composite's 20.7%.
And it certainly outperformed the S&P 500's 16.2%.
It did.
So why? If the UK economy has been battling inflation and all these political headwinds, how did their index lead the pack?
It's a combination of structural factors and timing. Analysts point to falling domestic interest rates, generous shareholder cash returns, M&A activity.
But the core reason is the FTSE 100's unique composition.
Exactly. It's a defensive mix. It has a bedrock of yield support from consumer staples and utilities, and that's balanced by strong commodity plays and financials.
So it functions as a kind of de facto global hedge.
It does. And analysts are forecasting 14% profit growth in 2026, which is strong.
But if the returns are that strong, why are international investors still, and the sources, very uncomfortable with British equities? What's the risk they're seeing?
We're seeing valuation versus momentum. While the market is exceptionally cheap compared to historic averages.
Which makes it an attractive value play.
Right. But it lacks a clear catalyst for accelerated growth. The discomfort is rooted in growth and taxes and politics.
So investors are wary that domestic policy risks could derail that profit narrative.
Exactly. JP Morgan sees maybe 5% to 10% upside, but it's a cautious view. It's a value trade, not a momentum trade like the US Mag 7.
It's the difference between a high-yield savings account and a high-growth tech stock.
A perfect analogy.
And that brings us perfectly to the ultimate defensive trade right now. Precious metals, which are screaming a very clear message about global fiscal uncertainty.
We saw gold and silver hit new record highs this morning. Gold soared to $4,445.08 per ounce. That's up nearly 70% year to date.
And silver, which is often seen as gold's industrial cousin, shot to a record $68.96 per ounce,
marking a stunning 128% gain year to date.
So what does this massive run in these traditional safe haven assets really mean? Is this just year-end rebalancing, or is there something more structural happening here?
The so what here is that the market is placing a quiet vote of no confidence in long-term government spending.
A monetary potential hedge.
That's the phrase Matthew McLennan of First Eagle Investments used. This surge isn't just rebalancing, it's driven by deep-seated concerns over outsized fiscal deficits in every major global economy.
So we're talking about long-term fiscal credibility being questioned across the board. The US, the UK, Europe, Japan, China.
Everywhere. When you see this level of interest in gold, investors are protecting themselves against the long-term instability of fiat currencies.
McLennan even noted he is, and I'm quoting, quite focused on here is the long-term fiscal credibility of the United States.
The high debt trajectory means investors are skeptical about whether governments can or even will curb their massive spending habits.
And that skepticism drives money into assets that have historically held value, regardless of sovereign currency stability.
Which is why the bond market bears such close watching this week.
Right, let's look at policy and U.S. fiscal headwinds. This short week is entirely about debt demand.
The U.S. Treasury has an immense $183 billion in auctions lined up.
That includes $69 billion in two-year notes, $70 billion in five-year T-notes, and $44 billion in seven-year notes.
That volume is huge for a shortened trading period. It's a crucial stress test for investor appetite for U.S. debt heading into 2026.
And if demand is weak, yields will continue to climb, which just intensifies the fiscal pressure.
Meanwhile, the Fed remains steady. Expectations for a January rate cut are extremely low.
Officials are still reinforcing the need to maintain rates for months,
prioritizing price stability over easing any labor market weakness.
Speaking of fiscal pressure, let's talk about a looming sort of quiet risk that Yahoo Finance reported on.
The Supreme Court case.
Yes, the one challenging the legality of tariffs imposed under the 1977 International Emergency Economic Powers Act. This feels like a massive administrative problem waiting to happen.
It truly is. If the Supreme Court rules against the government, the National Economic Council Director Kevin Hassett noted it could trigger up to $100 billion in refunds.
$100 billion! That money collected from importers over time would have to be paid back.
Which creates an administrative nightmare and a significant unexpected hole in Treasury revenue.
And yet, despite that gargantuan legal risk, the administration is still moving ahead with plans to spend this uncertain tariff revenue.
It's incredible. Hassett mentioned that plans for $2,000 tariff rebate checks are now deemed likely.
And they've also announced a $1,776 warrior dividend for service members.
Both financed by this same potentially unstable pool of tariff revenue. It's an unusual position.
Promising spending from a source that's currently being challenged in the highest court in the land.
It just showcases how deeply tariffs have transitioned from being mere trade barriers to being essential political revenue tools.
Right. When they become a consistent source of funding for popular spending initiatives, unwinding them becomes politically and fiscally almost impossible.
Regardless of their original intent.
And before we close, here is a highly relatable aha moment that ties policy right back to your wallet.
The time lag.
The time lag. Even when the administration does lift tariffs on consumer goods like they did on coffee, and cocoa U.S. consumers should not expect to see their coffee prices retreat until well into next year.
Potentially up to 9 months later.
Why so long?
It's entirely due to supply chain lags. You have to account for shipping times, warehousing, roasting cycles, and all the existing inventory that was already purchased at the higher tariff rates.
So your local coffee shop and grocery store are selling inventory that reflects previous trade policies, not the current ones.
Exactly. High retail coffee prices are a delayed reaction. It shows us that the shadow of trade policy is very long and very slow-moving.
That's a great way to put context around market inertia. So to quickly recap our deep dive this morning,
Go for it.
we saw the AI trade mature and become highly selective, using a scalpel to separate winners like Micron from scrutinized capital spenders like Oracle.
We noted the UK FTSE 100's surprising defensive outperformance, driven by its commodity exposure and attractive valuation, a classic value hedge.
And we tracked the stark fragmentation of global trade, China hitting EU dairy, while India strategically builds protected bilateral pacts, all set against a backdrop of increasing U.S. tariffs.
And that fragmentation, coupled with fiscal uncertainty, is what's driving money into gold and silver.
And that increasing popularity of precious metals, driven by these fears over U.S., U.K., and European fiscal deficits, raises a really critical question for you to consider this week.
It does. When major trading blocs like the EU struggle to ratify new pacts, like their failure to finalize the Mercosur deal, and are then forced into trade deals viewed as unbalanced with the U.S.
What does this ongoing fragmentation and the reliance on traditional hedges ultimately mean for the long-term credibility and stability of sovereign currencies?
That fiscal credibility tension is the core narrative heading into 2026.
We'll see you all tomorrow morning with new headlines from major financial magazines.